The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to webinar session 4, Lean Decision Making Using the Box Score. This is a repeat of last Thursday's session. First thing I would like to do before we get started is I want everyone to let me know via chat. Can you see me on my video? Can you see the screen, the presentation? And can you hear me? If the answer is yes, just type yes in the chat. If the answer is no, please let me know. So can anyone not see me or hear me? Okay, well, let's get started. So today, again, session 4, Lean Decision Making Using the Box Score. What I wanted to do before we get started is Thursday's technical issues really is a good example of lean problem solving. So what I did, and I just wanted to sort of spend a couple minutes on this. So what I did is I did a root cause analysis of the problem. And here is a simple problem solving report. So the presentation was not visible to any of the attendees. Now, many people submitted chats saying they couldn't see the slides, but I was unable to read the chats because I was making the presentation and my control panel was minimized. Now, on previous webinars, our assistant, Susan Lilly, was there, and we used to do a verbal check before the webinar began on audio and video. So I set a goal of having standard work at 10 minutes to the webinar. I'd make sure that everything was working, and I wanted to confirm somehow that the quality was there. Now, that was the goal. Root cause is that our assistant was not available for the previous webinar. I relied on my memory to make sure things were proper. And also, because I relied on my memory, I'm also trying to concentrate on whether as I'm ready, preparing for the webinar. So I have a lot of things on my mind. So my solution, which is on the countermeasure, is a written checklist, which is, if you see, is right here. So I created this written checklist where I checked everything off beforehand, and I was going to do I did a verbal confirmation at the beginning. If you could not see me, could not see the screen, could not hear me, that you should submit a chat. So as of now, I have no chat saying you can't see me or hear me. So I guess everything's okay, and we'll move on with the presentation. So this is just an example of lean problem solving, getting to the root cause analysis and trying to really not understand what happened, but understand why it happened, and how do you put countermeasures in place to prevent things from occurring in the future. So today what we're going to do is we're going to review the fundamentals of the box score, and then we'll talk about value stream capacity for a few minutes. The majority of the session will be looking at lean decision-making examples, how you use the box score to make good decisions in lean companies. And then we'll wrap up with questions at the end. And please submit all your questions in the chat panel. So the box score is a three-dimensional view of value stream performance. It's How well are we doing operationally using the value stream performance measures? How well are we using and utilizing our capacity, our resources? And how well are we doing financially? The important thing about the box score is the relationships between the three components of the box score. It's very important to be able to understand the relationships based on how things relate to each other. How does operational performance impact capacity, impact finance? How does the capacity usage impact operational performance and financial results, and vice versa, and all the way around? So the box score is our value stream performance measurements, which we talked about in session 2. Productivity, quality, delivery, flow, cost, and other measures such as employee engagement and lean. Typically, these measures are shown on a weekly value stream performance board, and then they can be incorporated into the box score. Our value stream income statement, which we talked about in session 3. What are the actual revenue and actual costs for the period being reported? Now, this slide talks about weekly results, and ideally you'd like to report the box score on a weekly basis. Obviously, sometimes it's hard to get certain numbers on a weekly basis, but you try to do the best you can. The reason we focus on weekly reporting is it's a very short cycle compared to monthly. And when you're dealing in, Lean likes to deal in short cycles, because when you have a short cycle, it's easy to understand when you're not hitting your target, and it's easier to do the root cause analysis. And finally, capacity. How well are we utilizing the resources in the value stream in terms of productive capacity, non-productive capacity, and how much is available? So the box score is a few key measurements. We want the timely financial information that is designed for internal use for non-financial people. And we want to, over time, see an increase in productive capacity, a decrease in non-productive capacity, and that means that the lean business strategy is working. For decision making, the box score becomes standard work in a lean management accounting system. It can be used for just about every type of business decision, all the way from something that is operational in the value stream, all the way up to strategic decisions made by senior leaders and owners of businesses. So let's spend a few minutes talking about value stream capacity. We talked about the performance measurements in section 2. We talked about value stream income statement in session 3. Capacity is a unique measurement in the box score because it doesn't appear on the financial statements. What we're really doing is measuring the utilization of resources in regards to time. So productive capacity is defined as producing to customer demand. Not overproduction, not producing any product, but just producing to demand. Everything else is considered non-productive. So this would be all of the waste in the process. This would also be things like overproduction. And the third component is the available capacity, which is currently not being used. Typically, this information comes from value stream maps. And really what we're doing here is we're quantifying time in terms of how the time of our resources are being used. People that have lean experience really understand this. And many lean people who we've worked with over the years, they really, really like the capacity numbers because it quantifies what they intuitively know they're doing in terms of eliminating waste. If you're new to Lean, whether you're in finance or not to Lean, this is a new concept. Now, what's interesting about capacity is that the capacity numbers really don't appear on the financial statements. However, the cost of the capacity, the amount that you spend in labor, the amount on your machines, the amount of your facilities, that does appear on the value stream income statement. The process of Lean in terms of implementing practices and continuous improvement is we have a current state level of capacity, productive, non-productive, and available. And ultimately, over time, what we do is we free up the resources. Most continuous improvement, most Lean initiatives create capacity. And that's what the box score reflects. Now, the real question when you get into the analysis of the box score and the financial impact of Lean is it shows up on the box score. So in this example, we see improvements in on-time delivery, improvements in quality from 71% to 78%, and improvements in flow where the days of inventory go down from 33 days down to 18 and a half days. From a financial standpoint, you don't see much change in value stream profitability. Material cost goes down a little bit because our quality is improved and our flow is improved, so we're not consuming as much material cost. However, our conversion cost, which is really the cost of our capacity, remains the same. And this is typical of Lean practices and initiatives where you see operational improvement, but you don't see the financial improvement. Now, this can be very frustrating for non-financial people or inexperienced lean people to understand, well, Lean's supposed to be so good, why aren't we seeing the financial benefit? And this is where the capacity numbers come in. So in this case, the improvements made from the current state to the future state have almost doubled the available capacity for both employees and machines. So this is one of the benefits of using the box score is you can actually see from a numerical standpoint what is going on with all of the Lean initiatives in place. The real question about when we do the financial analysis is, what's the financial impact? That's what everybody wants to know. And really, the financial impact of improvement is related to how you use the available capacity. And there's really three things you can do with available capacity. You can sell more products and services. You can redeploy resources and move them from one value stream to another. You can also eliminate resources. For example, get rid of a machine. I would like to say here, one thing you don't want to do is get rid of people because of continuous improvement, because that will just basically eliminate any further continuous improvement. And I think on Thursday I said if people associate reduction in headcount with continuous improvement, it's very toxic to Lean. But really, the decision as to how to use the available capacity really impacts the value stream profitability. Now, sure, there may be some direct costs that are saved due to any kind of Lean initiative, but the majority of the financial analysis is based on what happens to the available capacity. So now let's spend most of the rest of the webinar looking at different types of decisions. And we are going to look at make-buy decisions, looking at weekly performance review of the box score. We're going to look at how do you use the box score for KAIZEN and continuous improvement events, the impact of new demand on the impact of new demand on profitability, capital purchases, and longer-term planning. Let's continue. So the first one we're going to look at, first example, is weekly reporting. Now this is really done at the value stream level. A value stream owns the box score. It's theirs. They should be heavily involved in the calculation of most of the box score. Obviously, they can't get the financial information, but you want them to own it, because when you have ownership, you have accountability and responsibility, and the overall goal of the value stream is to improve the box score over time. So in this case, this example, you always see a goal. And a value stream should be working typically at a goal of maybe improving every quarter performance. And the weekly reporting is to measure how well we are trending towards achieving the goals. The responsibility of the value stream on a weekly basis is to meet and do the root cause analysis to understand operational performance, understand, is the capacity changing, meaning are we reducing our non-productive time? Are we creating available capacity and then eventually turning that available capacity into more productive capacity by producing and shipping more? And finally, after you look at the performance and the capacity, you want to look at the financial impact. So what we see here, and this, by the way, this is a healthcare box score, not a manufacturing box score, is you can see that there's been some improvement in the value stream performance measures. They haven't totally hit their goals, and there's been some inconsistency, but they're trending overall in the right direction. From a capacity standpoint, you see that the available time has increased from 19% up to 33%, which is an indication that continuous improvement activities are successful. From a financial standpoint, the goal, if you look on the lower right-hand portion of the box score, is a 10% return on sales. And you can see that it's sort of fairly inconsistent at this point. They hit it a few weeks, but not consistently. And if you sort of look at the revenue and the expenses, it's primarily related to the variability of the revenue. So again, why is revenue so variable? Maybe it's because of length of stay, who knows? Maybe it's because of billing issues, but the whole idea is to drive root cause analysis and understand the relationships. Make-buy decision. Now, this is a very common decision, especially in manufacturing. Should we produce a product in-house or should we outsource it? So in this case, we have a current state, and you can see in the column the current state box score. We have a choice here. We can outsource production for a certain product, or we can make it in-house. If you look at the outsourced column, what's the impact on all three aspects of the box score? On-time delivery goes down, inventory days go up, and quality goes down, which is typically what happens, not all the time, but typically what happens when you outsource, because you give up control. The capacity remains the same because we're outsourcing. From a financial standpoint, our material cost goes up from $765,000 to $871,000. All other costs remain the same, and yes, we do make more money from $242,000 up to $271,000. So it's okay to outsource. But if we make it in-house, the first issue is we don't have enough capacity. We only have 6% available capacity, so we have to invest in capacity in order to have enough to make it in-house. What do we see from a performance standpoint? Our on-time delivery gets better. Inventory pretty much remains the same. Quality gets better. Our average cost goes up because we have to invest in the capacity. And you can see we now have 15% available capacity. Most importantly, from a profitability standpoint, our profits are higher when we insource rather than outsource, 312,000 compared to 271,000. The lesson here, and this just summarizes the value stream income statement. The lesson here on make-buy is if you have the capability to produce a product or deliver a service to the quality requirements of the market, it's best probably to do it in-house because you control the process, you can manage the flow, manage the quality, manage the delivery. Outsourcing is not simply a cost decision. There's many, many companies that have outsourced. If you outsource to a low-cost country, you end up having to hold inventory to keep your lead time short. You might give up quality. You have freight costs. There's lots of costs associated with this. So again, the box score examines the relationships between operations, capacity, and finances when you're making an in-source-outsource decision. When we're analyzing the impact of product demand, whether it's a new product or selling more of an existing product, this is a very good use of the box score and is very different than traditional type financial analysis of what's the profitability of a product. If you use some kind of unit cost analysis or standard cost or some kind of rate, it's typically not accurate. And we showed some examples of that in session 1. So here's an example. We have a current state box score. We want to introduce a new product. And you can see from a financial standpoint, we add $448,000 of revenue. Our material cost is a variable cost and it goes up. And there's a few other variable other costs which go up. So we know our costs are going to go up. But as you can see, we run out of capacity. We don't have enough capacity. So we have to determine how much capacity needs to be added to meet this level of demand. So we revised the box score with the increase in capacity. So now we're at 11% capacity. You can see our labor cost has gone up from 267 to almost 320,000, and our machine cost has gone up from 59,000 to 71,400. So our costs go up because we need the capacity. Our profitability is still good. Our return on revenue goes from 20% to 28%. So the lesson here is what are the actual change in value stream costs based on the decision that is facing us in terms of selling more products. And we want to use actual value stream costs, not any kind of rate, not any kind of allocated cost, because that doesn't give us the real impact. If you're looking at a long-term impact of a new product, this company, in this example, they did a 3-year box score. Again, based on best numbers that they know, what they were looking for is when will we have to add resources over time based on additional demand. And the additional monthly quantity you can see on the second row. And if you look at about the 1-year standpoint, when they get down to 7% capacity, they realize they have to invest in people and machines soon after that in order to meet the demand. Then you can see as they see the demand going up, they start investing more frequently to maintain that level of capacity. And at this point, I'd like to make a note here about available capacity. Lean companies typically like to maintain a level of available capacity for the unknown. So a lot of lean practitioners call it buffer capacity. You don't want to always, you want to, things go wrong, even in a lean company. Uh, People are absent, machines are down, maybe you have variability in demand. So you want to maintain this level of available capacity to handle the unexpected and maintain flow. So typically, like I said, it's about 10, 15 to 20% available capacity depending on the company. In terms of product rationalization, so a lot of times in companies, you want to look at your products and you want to get rid of low margin products. Typically, this is done using a product cost. And so if the product cost is too high and the standard margin is too low, you either outsource or maybe you just stop producing the product. And the worst case scenario of that is the overhead death spiral, which we talked about in session 1, where if you outsource products based on a low standard margin, all of the remaining products, their product cost now goes up because that overhead has to be spread over fewer products, which typically leads to more products being outsourced, and then rates go up and pretty soon you're out of business because you don't think you're profitable anymore. From a box score viewpoint, what we want to do is look at the impact of removing the products from the value stream. So this company did an analysis in June of 2003 of removing low margin products which were difficult to make and caused a lot of problems in the production process. So what happened operationally? Productivity went down. On-time delivery actually went up because these products were difficult to produce. Our inventory days went down and our quality got better. Average product cost obviously went up because fewer units were being produced. The available capacity changed dramatically, went from 13% available to 47% because these low margin products created a lot of waste in the process. We didn't lose much from a profitability standpoint, as you can see from the value stream income statement. Monthly profits went from $4,362 to $4,134. So we didn't lose much. So what this company did is they used that available capacity to introduce new products a few months later. What was the impact? You can see that profitability is now $6,180. So it's about 50% greater than June of 2003. Overall performance is better than January 2003, and our capacity numbers are in pretty good shape. We still have a lot of available capacity left to add more demand. So if you're looking at product rationalization, use it in the box score, because what happens is if you remove products from a value stream, you're reducing the demand. And you reduce the demand, you create more capacity. The question is, from an operational standpoint, what's the impact of producing those products? Do they create quality problems? Do they create flow problems? Do you have poor suppliers that require you to hold inventory? Those are all logical questions which must be asked when looking at product rationalization. Capital purchasing. And even though we're going to be talking about machines here, it's also important to note that if you're looking at hiring people, it's the same type of decision, because people or machines typically do the value-added work to produce the products or services that you need. So in this case, this company did a 6-month box score, projected, based on the current forecast of demand. And you can see from the available capacity line that available capacity consistently goes down because demand is going up, especially in the month of November. So looking at a sort of longer term box score, you can be a little bit predictive about when you might run out of capacity based on the latest demand forecast. So in this case, what this company decided is they had to add capacity in the month of October, buying 2 new machines, hiring people to run the machines in order to meet the demand for November and forward. So as you can see, our conversion cost goes up and our value stream profit goes down a little bit compared to September, but in the long run, we're going to be okay with our capacity. Now, you'll still note in November, there's a negative 1% available capacity because of this really out of trend spike in demand. So in this case, what this company did is, as opposed to buying more machines or hiring more people, which is permanent capacity, they decided that they would work some overtime to meet that shortfall in capacity just for the month of November. So the lesson here, from a lean viewpoint and a lean accounting viewpoint, is that lean companies are typically very rational about adding capacity because they know that it's going to increase their costs. And if you hire people, especially full-time people, if you buy machines, you're in essence buying permanent capacity because it's very hard to get rid of a machine once you buy it. And if you hire full-time people, you're really, in a lean company, you're making a commitment to them. It's not like you want them to just, be gone in a few months. So if you think you have temporary increases in capacity, you would want to use if you have temporary increases in demand, you would like to have temporary increases in capacity so that you can flex that capacity back and lower your costs when that demand goes away. Lean companies typically use temporary workers. They might do outsourcing, or they might work overtime in this case. Another example of purchasing capital is looking at alternatives. And in lean lexicon, this is called a 3P analysis. So here's an example of a company, again, it's in healthcare, where they have a chance to automate a manual process. The manual process is the first column on the left. And there's 6 different types of machines that can be purchased to automate the manual process. So the way that a rational decision would be made would be to look at the box score impact of every one of these machines. And you can glance at these numbers, but I want to sort of just drive you over to the flow and place automation Bennis 12 machine, the second to the last column on the right. As you can see that the productivity is higher, the quality is not the lowest, but it's lower than the current state. The length of stay is second lowest. Patient satisfaction is high. It does a good job on capacity. And from a profitability standpoint, it has the highest monthly value stream profitability. So this is probably the best machine to buy. And the reason for the profitability is patient satisfaction. So the lesson here is that a capital purchase decision is based on more than just internal rate of return or payback period or how much it's going to cost. It's related to the impact on operating performance. It's related to capacity needs and also the financial impact of the decision. So now we're going to look at the financial impact of continuous improvement. In my years of teaching and training lean accounting, this is probably where lean companies like the box score the most because it gives you the information of what really happens in a continuous improvement event. So when you're planning a Kaizen event, you can probably do a very simple projection of what you think might happen in the event from a box score viewpoint. So in this case, you can see that the productivity improves. That productivity number is supposed to go down. Quality, again, gets better. Defects per patient day go down. The length of stay goes down. Patient satisfaction gets higher. Average cost per day goes down. So it's good operationally. Capacity-wise, we see some shift in capacity between productive and available. Non-productive goes up a little bit. The reason that the non-productive capacity goes up is because the primary benefit of this, if you look at the salary and wage line, is that we're creating a lot of available capacity in the people that work in the value stream. So it's expected that we will be able to transfer these employees from one value stream to another value stream. So again, you do this at the beginning to get a general sense of where you're headed with this Kaizen event. Most formal Kaizen events have a report out, which is where the team presents what the results of the event are. Incorporating the box score into the report out is very, very good. And the reason is that it quantifies what the team did. Many times when you do report outs, it's very difficult for people who were not involved in the event or maybe don't work in the value stream or the process to understand what goes on in the process. When you can use the box score, people understand the numbers and they understand the movement of the numbers. And so it's a very simple way to explain the impact of the event. So in this case, they pretty much hit their targets, and that's what they think is going to happen. Now, even though you finish the Kaizen event, you want to closely monitor whether the improvements have been sustained. So that's the idea behind a 30, 60, 90-day report out, where the team will use the actual box score in the value stream and compare it to what we thought was going to happen based on the report out. So here you see the 30-day report out that the numbers from a performance standpoint really haven't hit what we thought was going to happen when we did the report out. So what you want to do here is get this team together and do some root cause analysis and understand why some of the improvements in the Kaizen event may not have been sustained. The final example is the utilization of available capacity when it comes to long-term planning. Just want to check, see if we have any issues, and we don't. So in this case, this example, you're going to see that we have current and future state value stream maps for a value stream in a company. And the future state box score is going to project an increase in available capacity. So from a long-term planning viewpoint, what are the alternative uses of the available capacity that will drive the financial analysis? So here's our example, which is one that I showed you earlier, where the available capacity for people and machines increases from 19% to 37% and 15% to 29% respectively. So capacity is almost doubling. Available capacity is doubling because of the operational improvements to get from the current state to the future state. And as you can see, there's not much financial improvement at this point because we haven't made any decisions about how to use or what to do with the available capacity. So in this case, the senior leadership team looked at three alternatives. Number one would be, let's take the available capacity in terms of employees, transfer them from one value stream to the other value stream. So in this case, you see that the available capacity of employees goes from 37% to 9%. From a financial standpoint, our conversion costs go down and we make more value stream profit per month. So it's a good, sound decision. Another example, or another alternative, would be, can we sell more? So in this kind of situation, when you're looking at long-term planning, you want to get the sales and marketing people involved in terms of what's the forecast? What can we go out and sell of our existing products with all this available capacity? So in this case, sales and marketing comes back with a revised demand forecast where you can see the monthly sales goes from 332,000 to almost 428,000. Our material cost goes up because it's variable. Our conversion costs remain the same because we have the available capacity, and now we make $172,836 rather than $104,000. So increasing demand or increasing sales is much more profitable than just removing the capacity. The third alternative this company looked at was bringing outsourced products back in to the value stream. So in this case, you can see they have plenty of capacity to do that. It goes from 37% to 26%. The material cost goes down from 108,000 down to 92,000, and again, we're making more money. So when you're looking at long-term planning alternatives, again, you want to create a box side-by-side box score with all of these alternatives. Which one is most profitable? Obviously, it is increasing demand. And typically that is the case. The question is the demand there? What does sales and marketing have to do to bring that demand, turn that into actual orders? So again, as you're looking at long-term planning in a value stream, compare your alternatives and have a logical, rational discussion about, which one do we think will occur. So now I'm going to wrap up. In terms of lean business decision making with the box score, the box score supports the lean growth strategy. Remember, we talked about lean being a creation of value, driving revenue growth, and managing costs, which we call the economics of lean. And the box score, analyzing the relationships in the box score when you're looking at a decision, really forces a discussion about the economics of lean. The box score is pretty simple. The numbers are there, they're reported on a weekly basis, there's standard work behind the numbers. So if you're using the box score, you can actually speed up your decision-making process. You don't have to create a unique analysis for every different type of decision. It also empowers the value stream because they're part of the decision-making process. Obviously, a value stream would not make a strategic decision for the company, but they're using their box score and they participate. And many times, what you find with the employment of the box score is senior leaders spend more time talking to value stream managers because they realize that the value stream managers really understand at a very detailed level what's going on in the value stream, and if we make this strategic decision, what's going to be the impact. The final part of why we want to use a box score is accuracy. The box score is based on real numbers, actual performance measurements which are kept on a weekly basis, capacity measurements which are done based on value stream maps, and most importantly, the value stream income statement, actual revenue and actual costs. And what we're looking at is ultimately the change in value stream profitability. The overall goal of lean practices and the decision making is to improve the return on sales over time. You have a current state profitability rate. You want to look at the profitability impact of the business decision and calculate a future state profitability. So if the future state return on sales is greater than the current state return on sales, it's probably a good business decision from a financial standpoint. Now, obviously, there may be non-financial considerations to take into account, but in general, this is a good rule to follow when you're analyzing the box score. Does the decision make sense operationally? What's the impact of the decision on capacity? What is the financial impact of the decision? Those are the three questions that the box score forces whoever is analyzing the box score to answer. And what are the relationships? So that wraps up the presentation. Here's a list of our services that we offer. And here's some other information about our website and some upcoming workshops in the next few months. So now what I'm going to do is I'm going to open up the chat pane. I'm going to open up the questions and see if there are any questions. And so it was really, really nice that a lot of people said yes, I appreciate that. So now I'm going to answer some questions. So Kent Bradley has this question, and it was about my problem-solving report and my reliance on memory. Assigning the first route to the assistant who may be susceptible to demonstrating, okay, and mistake-proofing the process. So what Kent said is that, I probably could have done a little better root cause analysis than relying on memory, but again, I'm just trying to show you a simple example of what I did. Kevin Fitzgerald asked me a question about a more complete definition of conversion costs. If you go back to the value stream income statement webinar, which we defined all of the costs, conversion cost is really a summary of labor costs, machine costs, facility costs, and maybe any of the other miscellaneous costs in the value stream. Conversion cost is a term that has been around for a while. I like to look at production costs. So Bob Oliver has a question. What method do we recommend to determine low margin products? And he asked if it's contribution margin. And that's really a very good response, Bob. If you, on a product basis, you can calculate the contribution margin of an individual product, even in a lean company. That would be the selling price of the product less the material cost, because you can get a per unit material cost. What you don't want to do is start allocating labor and overhead to that cost. But you can use that product contribution margin to determine what products are higher or low margin. You can calculate an overall average contribution margin for all of the products in the value stream, and then compare individual product contribution margins to the average contribution margins. A word of caution, though, is you don't want to develop a broad rationalization that every product that is below the average contribution margin should be eliminated, because you have to look at the material content and why are we paying what we're paying for material. Maybe there's an opportunity to reduce the material price by looking at suppliers. Secondly, the price in the market. Okay, and there's many, many reasons for selling products. I mean, you don't always sell the highest margin products. Sometimes you sell low margin products because they're required in your portfolio. So Peter Baxter has a question. that the financial metrics I mentioned show return on sales, but not return on capital employed. I mean, that's a good measure that can be used. I think the real key, if you're looking at a return measure, so return on capital employed, which would be the resources, that's fine. You would want to use, my point is use the value stream profitability to calculate your return on capital employed. So Kent Bradley has another question about productive capacity for the box score and wanted to know if the calculation was rolled up by standard work for the product. Okay, where does this come from? Typically, the short answer is yes. The standard work for the product, which is the value-added time, helps create the value stream capacity. And I might be doing a webinar in the future that actually shows you how this is calculated. So let's look. So Gary Kapanowski asked, are there standard box score metrics used for organizations? Pretty much what we've done in performance measures and value stream P&L, and this one is really what the standard is. What you have to do is you have to take your company compared to what we sort of train in terms of the standard and determine what is best for you. The final question, is there any examples of other financial metrics such as economic value added, net present value, etc., in terms of the box score? In terms of net present value, again, if you use the value stream income statement to determine what the cash flow is, you can use net present value analysis. I'm not that familiar with economic value added, but again, I sort of have the same answer. Use the value stream income statement and then perform any type of typical financial analysis that you want that are such as EVA, net present value, internal rate of return, payback period. So that wraps things up for today. I appreciate your questions. I appreciate you listening again. And this recording will be made available later this afternoon. And you will be getting an email tomorrow with how to get the recording. So thank you very much. We'll see you tomorrow at 11 a.m. Eastern Standard Time in the US for the fifth and final presentation, which is about standard costing and the lean accounting transformation. Bye-bye.